Hello, I hope we're all doing just fine. 2023 has been another difficult year with a number of factors that have had a negative impact on M&A transaction volume and turnover. Number one, the fight on inflation. Restrictive monetary policy has triggered decreasing corporate output together with rising interest rates. Sales growth slowed, together with transactions becoming more expensive and less leverageable. 2. Ongoing military conflicts. Uncertainty continued as a new conflict emerged in the Middle East, and the Russian-Ukraine crisis will soon turn 2 years old. 3. Climate change and planet overheating led to a more selective trend towards ESG transactions. All of these combined are some of the main contributors to the significant decline in M&A deals, both for strategic buyers and institutionals alike. Lack of investment activity, limited exits, strongly contributing to lower transaction count and value, and extremely long transaction lead times, resulting in a surplus of dry powder. As a consequence, fundraising also slipped strongly. Countless transactions fell through due to the significant valuation gap between buyers and sellers. Many sale processes were pulled from the market. In such context, advisors played a key role and will be ever more important going forward. Creativity, mediation, and tact will be needed to get deals done. A blend of innovative transaction structures, ways of financing, performance-linked price considerations, combined with lower valuation multiples will be vital. Correct interpretation of due diligence on financial results and their sustainability will be fundamental. In recent times, though, pipelines have been rebuilt, both involving sleeping transactions and new ones. In fact, the latter part of 2023 warrants for greater optimism. This is due to 3 key factors. Inflation seems to have been curtailed, interest rate rises have come to a halt, the Russian-Ukraine conflict has not spread beyond the borders of the area, and the backlash from the Israeli-Palestinian conflict has not had negative effects on oil prices or world travel and tourism, a trend that has spiked post-COVID, which has been extremely resilient and beneficial to the economy. The downward trend we saw in the recent past, up until Q4 2023, will be interrupted. Private equity funds will no longer be in wait-and-see mode. In order for them to fundraise, they will need to exit investments and rebuild deal pipelines. There are a lot of quality assets out there. The key will be to invest and divest simultaneously, planning fundraising as well. Private equity professionals will be under considerable pressure, but we will be at their side to help. In 2023, CrossCourt Capital visited 62 companies, first-time visits, of which 34 were subsequently object of an introductory meeting with our client investors. Such pipeline yielded for the current year non-binding offers, with 5 transactions being granted exclusivity. This year, our activity included soliciting, approaching, and visiting targets for 3 exclusive add-on acquisition assignments. This service line is at the forefront of our product offering. We scout, screen, profile, define a short list with our client, approach identified targets, and proceed to 1 or more acquisitions. Our add-on acquisition offering is also aimed at providing deep dives for the identification and subsequent search of new investment platforms. In addition to our traditional buy-side activity, 2023 saw us trusted on a mid-market sell-side assignment still underway. As always, you can check out our 2023 origination and execution statistics on www.crosscourtcapital.com. From a target industry point of view, the current landscape of sector interest is evolving. ESG issues, technology, and aging population are redefining the targeted industries. Examples of sectors our clients are targeting are energy transition and renewables, smart and electric grid infrastructure, healthcare and personal care, and above all, ITC, including telecoms infrastructure, artificial intelligence, data transmission, security, and storage. We're positive on 2023, and will strive to advise in this difficult environment, providing clear, senior, independent advice with the skills and experience that are needed in a strongly competitive investment landscape, characterized by significant pressure to complete transactions after a long period of limited investment activity. And on this note, we're here as always in wishing you and your families a peaceful holiday period and a prosperous, fulfilling new year. Take care.